Imagine you manage a massive pool of capital.
Right.
Do you, like, lock it away in a Swiss vault just to keep it safe, or do you deploy it into the U.S. market to capture a guaranteed high-yielding return?
Well, that is the exact dilemma right now.
Exactly. So welcome to the deep dive. Today, we are mapping out the macro landscape of the U.S. dollar against the Swiss franc for Q2 2026.
Yeah, we're really looking at the hidden mechanics here.
Yeah.
The incentives and the liquidity flows that are driving capital between these two currencies today.
Right. And it really comes down to a clash of priorities, doesn't it?
Oh, absolutely. I mean, we are looking at two central banks essentially playing entirely different games. They just have completely different thresholds for economic pain.
Yeah, and hearing you describe that setup earlier, I keep picturing this dynamic as a tug of war, but like the playing field isn't flat. It's severely tilted.
Right. The U.S. dollar is pulling downhill.
Exactly. It has the immense weight of high yields behind it, while the Swiss franc is struggling uphill, relying purely on its reputation as a safe haven.
That tilted field is just a brilliant way to visualize the rate differential today because, well, the Federal Reserve is holding firm on a restrictive stance, right? Which anchors a very clear, durable yield advantage for the dollar.
Right.
And on the other side, subdued inflation means the Swiss National Bank is keeping their rates comparatively low. So the system is fundamentally wired to incentivize capital to flow toward U.S. assets.
So it's not about spreads widening aggressively every single day, right?
Exactly. No, it's about the fact that the spread just stubbornly persists.
But let's pause there for a second, because rates are really only half the story. The real driver, the thing that cements this whole regime, is why the Swiss National Bank actually allows that tilt to persist.
Right, what we call policy asymmetry.
Yeah, exactly. Basically, their pain tolerance is totally different than the Fed's.
Yes, and we need to break down that asymmetry because it's just crucial to understand. So think about Switzerland. It is a heavily export-reliant economy.
Like high-end watchmakers, right?
Yeah, perfect example. If the Swiss franc gets too strong, a watch that costs a U.S. buyer, say, $10,000 suddenly costs $11,000 or $12,000.
Even if the watchmaker didn't change their price tag at all.
Exactly. An aggressively strong franc just destroys their global competitiveness.
Yeah.
And it actively tightens their domestic financial conditions.
So the central bank is like practically forced to step in. They have to cap their own currency strength.
They do. They have a massive structural incentive to resist franc appreciation. So you end up with one central bank perfectly comfortable sustaining high rates, and another terrified of its currency getting too muscular.
Wow, yeah. That makes me wonder about the liquidity flows then. If dollar demand is this constant structural force because of the yield, does the Swiss franc only attract serious capital when global markets just completely panic?
That is the crux of the trade right there. U.S. dollar flows in this environment are persistent. Capital wants that yield.
Right.
Swiss franc flows, on the other hand, well, they are strictly episodic. I mean, if the market is just dealing with normal, everyday uncertainty, investors don't abandon yield.
They stay in the dollar.
Exactly. The franc also takes the lead when pure, unadulterated fear forces a flight to safety.
Okay, so let's translate this into execution. Because if you are managing a book, how do you actually position yourself given this structural imbalance?
Right, because chasing a strong dollar feels really risky if the trade is crowded.
Exactly. So what do you do?
Well, it requires immense patience. You absolutely do not chase dollar momentum when it's surging. Instead, you wait.
Wait for what? Exactly.
You look for those episodic moments of short-term market panic, like a sudden volatility spike or a scary geopolitical headline when everyone reflexively runs to the Swiss franc.
Got it.
The franc temporarily appreciates, and you use those transient defensive flows as your window to buy the dollar at a discount.
So you treat the panic as an entry point, not an actual regime change.
That's exactly the mindset. You align your capital with the underlying macro architecture, not the headline volatility.
I love that. But any disciplined macro strategy needs an exit plan. We have to know what breaks the thesis. So let's move to our strategic outlook section, what matters next.
Right. So the campaign holds unless we see a definitive regime shift. And your invalidation criteria are highly specific here.
Like a dramatic Fed pivot.
Exactly. A pivot toward aggressive easing. Or if the SNB suddenly decides they can tolerate a sustained strong franc.
What about a broader market panic?
Yeah, a prolonged systemic risk-off environment that lasts months rather than days would do it. Or a structural erosion of global U.S. dollar demand.
Because any of those events would just completely reorder the liquidity flows we've been talking about.
Precisely. But until one of those specific triggers hits, the structural reward for holding the US dollar over the Swiss franc is just too strong to ignore.
That tilted playing field hasn't leveled out quite yet. So, we'll leave you with this final thought. If demand for the Swiss franc is purely a barometer for global fear, how accurately are current exchange rates pricing in the actual absence of systemic panic today?